If you're a seasoned business owner or just starting your entrepreneurial journey, this video is for you. Welcome back, Tried and True Tribe. As an accountant with extensive experience working alongside entrepreneurs like yourselves, I understand the unique challenges and aspirations that small business owners face. I often say that cash is king, but credit is queen, and you need both to win. My aim today is to provide you with a comprehensive introduction to business loans from an accountant's perspective, to empower you with the knowledge needed to make informed financial decisions for your business. Business loans serve as a vital financial tool for businesses of all sizes, which provides access to capital necessary for various purposes, such as expanding operations, purchasing equipment, managing cash flow, or positioning yourselves for new opportunities. However, navigating the world of business loans can be complex and overwhelming. It's where I come in to explain the process, clarify options available, and equip you with the understanding that you need to make the right choices for your business's financial health. Throughout this session, we will explore the various types of business loans, and there are lots of them. The factors that lenders consider when evaluating loan applications, and the importance of good financial management, and tips for maximizing your chances of getting to your yes. We'll also discuss the potential impact of loans on your business's financial statements and tax obligations to make sure that you have a well-rounded understanding of the implications. Remember, as an accountant, my primary goal is to help you make informed financial decisions that align with your business's objective and to contribute to your long-term success. I encourage you to actively engage in today's discussion, ask questions, and seek clarification on any topics that may be unclear. Drop those items in the chat and we'll be sure to address them. After all, your financial well-being is at the heart of our conversation today, and I'm here to ensure that you will leave with a clear roadmap for leveraging the ABCs of finance when it comes to securing loans to achieve your business goals. So, without further ado, let's dive into the world of business loans and set you on a path towards a brighter financial future for your small business. Let's explore the various types of business loans available, ranging from traditional bank loans to alternative financing options. Traditional bank loans come in the form of term loans, lines of credit, SBA loans, and commercial real estate loans. Term loans are the most common type of business loans. You borrow a lump sum upfront and repay it over a set period of time with fixed interest rates. Line of credit, on the other hand, is a revolving line of credit where you can borrow up to a predetermined amount. Interest is only charged on the amount you use. This is where I always say it's better to have it and not need it than to need it and not have it. Then you have SBA loans, which are backed by the U.S. Small Business Administration, offering variable terms and rates, which are stricter eligibility criteria. Commercial real estate loans are specifically for purchasing or refinancing commercial properties with longer terms and lower interest rate. SBA loans are backed by the U.S. Small Business Administration, offering favorable terms and rates, but with stricter eligibility criteria. Commercial real estate loans are specifically for purchasing or refinancing commercial properties with longer terms and lower interest rates. Then you have online lenders, which offer shorter term loans, merchant cash advances, and peer-to-peer loans. Short-term loans allow you to borrow a fixed amount with a short repayment period, typically used for like working capital needs. And merchant cash advances provide a lump sum in exchange for a percentage of future credit card sales. Your repayment will fluctuate based on daily sales. Peer-to-peer loans are where you can borrow from individual investors through online platforms, often with very competitive rates. Invoice financing, where you can sell outstanding invoices to a factoring company at a discount. This provides immediate cash flow, whereas invoice financing allow you to use invoices as collateral to secure a loan with unpaid invoices serving as the repayment. Asset-based loans like equipment and inventory. With equipment financing, you can secure loans specifically for purchasing business equipment, with the equipment itself serving as collateral. Then you have inventory financing, where loans secured by your business's inventory. This strategy is useful for businesses with significant stock on hand. Crowdfunding, where you can raise funds by selling equity shares of your business to a large group of investors through crowdfunding platforms. Reward-based crowdfunding is pre-selling products or services to fund business expansion. And then you have microloans, which are small loans typically provided by nonprofit organizations or government agencies, often for startups. Business credit cards. Credit cards designed for business use, which offer revolving credit with varying interest rates and rewards programs. Then you have peer-to-peer lending, similar to P2P loans, but involving borrowing from individuals or groups in a more informal setting. Grants, which are non-repayable funds provided by government agencies, foundations, or organizations with specific business purposes. Angel investors and venture capital, where you attract investments from high net worth individuals or angels or venture capital firms in exchange for equity ownership. Online marketplace lenders, where platforms that are connected to borrowers and various lenders provide quick access to funds with varying interest rates and terms. And then you have community development financial institutions, or CDFIs, that specialize in offering loans and financial support to businesses in underserved communities. Each of these business loan options come with its own set of advantages and considerations. The choice of loan type depends on your business's specific needs, financial situation, and long-term goals. It's essential to be careful to assess your options, compare interest rates, terms, eligibility requirements before making a decision. You also should consult with your financial advisor or tax professional to make sure that it's in your best interest to proceed. Lenders assess loan applications meticulously to determine the credit worthiness and risk associated with lending to a business. While specific criteria may vary from lenders and loan types, there are some key factors that lenders typically consider when evaluating applications, like your credit score. A business's or a business owner's score is a significant indicator of credit worthiness. Lenders use credit scores to assess the likelihood of timely repayment. Higher scores generally result in more favorable terms. Business financials, your revenue and profitability. Lenders will examine this information to assess your ability to repay. And then looking at your cash flow. Positive cash flow demonstrates a business's capacity to meet loan obligations. So lenders analyze cash flow statements to ensure there's enough cash coming in to cover the debt. Business plans. A well-structured business plan really outlines the business's objectives, strategy, and how the loan will be used. So lenders want to see a clear path to repayment. And then collateral. Depending on the type of loan, lenders may require collateral to secure the loan. This could be business assets or real estate or other valuable items that can be liquidated if the borrower defaults. And then personal guarantees. In many cases, specifically for small businesses, lenders may ask business owners to provide personal guarantees, making them personally responsible for the loan repayment. Business and industry risk, where lenders evaluate risk associated with the business industries and market conditions. And then loan purpose. The purpose of the loan really does matter. Lenders prefer loans used for activities to enhance the business's profitability or asset base, such as expansion or equipment purchase. And then the business experience. Lenders look at the experience and qualifications of the business owner and the management team. So a strong track record can instill confidence in the borrower's ability to manage the business successfully. The debt to income ratio, or DTI. This ratio compares the business's total debt obligations to its income. So lenders use it to assess the business's capacity to handle additional debt. And then loan amount. The loan amount and term affect risk assessment. So longer term loans require more extensive financial documentation. Legal and regulatory compliance, where lenders check if the business complies with all legal and regulatory requirements, and non-compliance can raise red flags. Market conditions. Economic conditions, interest rate trends, and market volatility can impact the lender's decision. So a stable economy makes lenders more willing to extend credit. Industry and competitive analysis. Lenders may conduct industry-specific analysis to understand how the business compares to its competitors and how it is positioned in the market. Lenders want to know precisely how the loan proceeds will be used, and this can impact the perceived risk and repayment ability. Personal and business tax returns. Yes. Lenders often request personal and business tax returns to verify income and assess your financial stability. Legal and bankruptcy history. Any history of legal disputes, bankruptcies, or other negative events can affect your loan approval. So it's crucial for business owners to prepare a strong loan application package that address all of these factors comprehensively, providing accurate and organized financial documents, a clear business plan, and a compelling case for how the loan will benefit the business can significantly improve your chances for loan approval. Understanding the lender's specific requirements and preferences is key to tailoring your application for success. Securing the funding you need for your business can be a competitive and challenging process. So to increase your chances of success, consider these tips. Improve your credit score. Maintain good personal and business scores by paying your bills on time, reducing outstanding debt, and correcting any errors on your credit report. A strong credit history is one of the most significant factors in the loan approval process. Prepare a solid business plan. Craft a comprehensive, well-structured business plan that outlines your business goals, strategies, financial projections, and how the loan will be used. A compelling business plan demonstrates your commitment and ability to repay the loan and maintain strong financial records. Keep meticulous financial records, including accurate P&L statements, balance sheet, and cash flow statements. Clear and organized financial documentation provides confidence to lenders. And then improve your cash flow. Lenders will want to see that you can comfortably manage your debt repayments and build a relationship with your bank. If you have an existing relationship with a bank or financial institution, leverage it. A history of responsible banking and a strong relationship with your bank can make it easier to secure financing. And diversify your revenue streams. Show that your business has multiple sources of income, reducing the risk associated with loan repayment. Diversification can be reassuring to lenders. And then offer collateral. If possible, provide collateral to secure the loan. Collateral makes lenders feel more comfortable. And then explore government programs. Investigate government-backed loan programs such as the Small Business Administration loans. These programs offer more favorable terms and lower down payment requirements. Consider alternative lenders. Don't limit yourself. CDFIs often have programs that may be more flexible that can help you. Prepare a strong loan application package. Present a complete and well-organized loan application package that includes your financial statements, tax returns, business licenses, and other documents required by the lender, and address any potential concerns proactively. Seek professional guidance. Consult with a financial advisor, an accountant, or a business consultant because they can help you understand the best financing options for your specific needs and guide you through the process. Network and build relationships. Networking with other entrepreneurs and professionals in your industry can lead to valuable connections and potential investors. Attend industry events and join business associations to expand your network. Demonstrate a track record. If your business is relatively new, showcase your personal experience and any previous successful ventures. Lenders may consider your entrepreneurial history when evaluating your application. And understand the loan terms. Thoroughly review and understand the terms and conditions of any offer and be prepared to negotiate if needed and ask for clarification on any terms that are unclear. Be patient yet persistent. Securing funding can take time. Be patient, and if one of your lender rejects your application, don't be discouraged. Keep looking for alternative options. Remember that each loan application is unique, and the most suitable financing option may vary depending on your business's specific circumstances. Tailor your approach to fit your needs and be prepared to adapt as you explore different funding avenues. Always be transparent and honest, as trust is crucial throughout the process. Taking out a business loan can have significant implications on your business's financial statements and tax obligations. So it's crucial to understand these impacts to manage your finances effectively and ensure compliance with tax regulations. Let's discuss some potential impacts on financial statements, like your balance sheet. When you receive a loan, it increases your cash or bank account because you now have the loan proceeds. However, this is offset by a liability, which represents the amount of the loan you must repay. The loan amount is recorded as a liability on your balance sheet until it's paid off. So as you make loan payments, the principal portion reduces the liability. On your income statement, the interest you pay on the loan is reported as an expense on your income statement. This reduces your net income, which affects your profitability in a positive way. Cash flow statement. Operating activities. Loan proceeds received are typically classified as financing activities, not operating activities. However, interest payments are considered an operating expense. Interest paid on business loans is often tax deductible. So this means you can reduce your taxable income by the amount of interest paid, which can result in a lower income tax liability. The principal repayment. The principal portion of a loan does not directly affect your taxable income. Principal repayments are considered a reduction in debt. Depreciation and amortization. If you've used the loan proceeds to purchase assets such as equipment or real estate, you may be able to claim depreciation or amortization deductions, which can further reduce your taxable income tremendously. Timing of deductions. The timing of when you can deduct interest and depreciation expenses can affect your tax liability. So you'll want to consult with your accountant, CPA, or enrolled agent to optimize these deductions. The tax implications of forgiveness or defaulting on a loan. If a loan is forgiven or if you default on it, there may be tax consequences. Forgiven loan amounts can be considered taxable income, and the default may result in the loss of any tax benefits associated with the loan. State and local taxes. Keep in mind that state and local tax regulations may differ from federal rules. Be sure to understand the tax implications of your specific state or locality. Tax credits and incentives. Some loans, especially those related to a specific purpose like energy efficiency or job creation, may come with tax credits or incentives that can reduce your overall tax liability. It's important to note that the impact of loans on financial statements and tax obligations can vary depending on the type of loan it is, its purpose, and your specific financial situation. So to ensure compliance with tax regulations and to maximize the benefits of your loan, it's advisable to work closely with a qualified accountant or tax professional who can provide guidance tailored to your business's needs. Additionally, keeping accurate and organized financial records is crucial for both financial statement reporting and tax compliance. I know that was a lot. However, we wanted to provide as much value and education as we can in these video series. So be sure to turn on your notifications for more videos like this. Put any comments down below and we'll be sure to respond. Tried and True Financial Services' mission is to empower entrepreneurs by providing them with the knowledge and strategies to gain better control over your finances while upholding the highest standards of ethics and integrity. Thank you for tuning in, and we'll see you in the next video.